This is the first in a two-part series, looking at the role of secondary markets in energy efficiency financing. Please keep an eye out for invitations for the second webinar, which will be held on March 31st. This series has been developed in partnership with the State and Local Energy Efficiency Action, or C-Action Network, Lawrence Berkeley National Labs, and the Yale Center for Business and the Environment's Clean Energy Finance Forum. It's been designed around a report just released by C-Action about accessing secondary markets for energy efficiency. We've just posted a link to it in the GoToMeeting chat window. It's a really impressive report, providing a really good introduction to the topic, but also containing a lot of detail and case studies, and I'd really recommend everyone listening today to check it out. Today's presentation is being brought to you by the team at the Yale Center for Business and the Environment's Blueprint for Efficiency, which is in its 6th year of providing public webinars emphasizing the latest trends and opportunities for energy efficiency. Each presentation is recorded and available through the Yale Center for Business and the Environment website and the Blueprint for Efficiency iTunes U page. A link to download the slides from today's presentation has also been posted in the chat window. We're delighted to welcome today's presenters, Emily Martin Fodderhans, I hope I got that right, and Chris Kramer, both of whom contributed to the C-Action report. Emily is a program manager at in the Electricity Markets and Policy Group at Lawrence Berkeley National Labs, and Chris is a senior consultant with Energy Futures Group with a focus on energy efficiency financing. Before I turn it over to the speakers, I'd like to remind our listeners that we welcome any questions that you might have, and we'll direct them to our speakers at the conclusion of the talk. We'll be allowing plenty of time for questions, so please, keep them coming. You can type these questions directly into the GoToMeeting chat window. With that, I'd like to hand it over to Emily.
This is Johanna Zetterberg from the U.S. Department of Energy. Michael, I'm going to be kicking us off today. I am the coordinator for the C-Action Network, and I want to just say a huge thank you to the Yale team for partnering with us on bringing this webinar to you today. Before we jump into today's topic, I wanted to briefly go over a little bit about C-Action. C-Action provides state and local decision makers with information on how to design and implement energy efficiency policies and programs successfully. Our information is informed by state and local experience to date. And our materials, such as the report that we're covering today, have been used by many state and local government officials and energy efficiency program administrators since we began about 5 years ago. As you can see here on this slide, we also have a wealth of information in other areas aside from financing solutions. I invite you to go to our website, which is written in green and small print at the bottom of this slide, caction.energy.gov, for more information on those materials. Next slide, please, Emily. The Financing Solutions Working Group focuses on the key barrier of addressing the high upfront costs of energy efficiency improvements. So as we go about our work, everything that we do is aimed at addressing this barrier. We currently have 4 main focus areas. The first is improving data access, looking across data collection practices among energy efficiency financing programs, and looking at considerations and best practices in allowing program administrators and policymakers to access quality data on financing product performance as well as other types of data. We also focus on ways to improve program design. We're also interested in the question of whether new and novel financing tools and capital sources are needed in this space, or whether conventional ones can address the barriers already. So we're addressing that question through our work. And then finally, we're exploring the regulatory treatment of energy efficiency financing and what are the issues and challenges that come up in that space, whether there are any recommendations moving forward there for regulators and their stakeholders. Next slide, please. This is just a snapshot of who the group is. On the left-hand side, you see our co-chairs. We have Bruce Schlein, who is the Director of Alternative Energy Finance at Citi, and Brian Garcia, who is the President and CEO of the Connecticut Green Bank. I am a federal facilitator along with my colleague Brian Ng from US EPA, and Emily Martin Fodderhans, who you'll hear from in just a moment, leads our technical advisor team at Lawrence Berkeley National Lab. To the right, you can see all of our current members representing a wide variety of expertise and perspectives. Next slide, please. Here is a snapshot of the Financing Solutions Working Group's website online. Please come here to take a look at some of our other resources. For example, we published recently a report on on-bill financing. We have others on credit enhancements and a general financing program primer. So please do visit the website when you get a chance. And I'll now hand it over to you, Emily. Thank you very much.
Okay, thank you, Johanna, and want to echo our thanks to the Yale team for setting this up, and to you all for attending and taking time out of your day. Again, I'm Emily Martin Fodderhans. I'm with Lawrence Berkeley Lab. I'm going to take us through about the first half of this presentation, and then I'm going to pass it over to our study's primary author, Chris Kramer. We have a lot to cover, but we do want to be interactive, so we're going to be taking questions throughout the presentation, so we'll pause occasionally to take questions, so please do type them into the chat window. We're also going to do a couple polls, so we may go quickly, but we're excited to share this with you all. So you can see here the purpose of our report is to discuss how secondary markets have been used to date by energy efficiency financing programs, and also how they could be used in the future. And the report was really inspired by some of the early transactions of energy efficiency loans that we saw in secondary markets, and then the hopes and aspirations for what secondary markets could do for energy efficiency financing that those transactions raised. And then we also cover sort of the other side of the coin and try to see, are there any trade-offs that using secondary markets can introduce? And then overall, we try to offer guidance and suggestions for program administrators who may be considering secondary market strategies. And I think we actually will do our first poll at this point. We want to keep you all engaged, so I'm hoping that the Yale team can make that happen, because I'm not sure how to do it. But we have a poll for you all at this point. Perhaps. Perhaps not. Okay, it's
up now, Emily.
Great, thank you. So we're going to have Chris facilitate this poll. Due to a quirk of the webinar software, I actually can't see it. But we'd love for you all to take an answer to this, take a look at this question and give us a sense of what you think the most important benefit of secondary markets for energy efficiency is. And Michael, you can close it whenever you think folks have stopped answering. All right. And Chris, will you chime in with the results? Thank you.
Yes, absolutely. So we had 23. It's actually it's interesting. One answer in particular is a little higher than the others, but 23% said lower borrowing costs. About 20% said increased demand for energy efficiency projects. The high one is 55%, so over half said increased capital supply, and then only 2% said other. So mostly one of the first three options.
Very cool. Great. Thank you all for doing that. And not surprisingly, we're going to talk about this later, and the answer is sort of all of the above. But that's really interesting to get your take on what you all feel the benefit of secondary markets is. So before we dig in, I'm going to do, hopefully you all are back to my slides and not the poll results. Chris, just holler if we're not. Thank you guys for bearing with us.
We're back. Yep.
All right. So just to level set on some definitions that we're going to use throughout this presentation. First, the most basic, what is the secondary market? So we define it as any market where a product is resold after its original sale. And it could be something as simple as me selling my car after I've owned it for a while. Scalping tickets would count as an example of a secondary market. Kind of the most common one we think of is the stock and bond market, where there's an initial sale of a security to investor, but then it's traded multiple times to secondary investors after its original issuance. And then in the energy efficiency context, the secondary market is any financial market where energy efficiency loans can be sold to investors, either as a single loan or as a package of loans that's divided into tradable instruments or bonds. And we'll talk through both of those scenarios. And then a brief word on what we mean by energy efficiency financing structures. We do want to remember that there are sort of two general types of energy efficiency financing structures or products that are out there. One are traditional products, things that already exist that can be used for energy efficiency, and that would be your credit card, your home equity line, a mortgage, existing products. And we don't focus on those as much in this report, but we do want to point out that there's some interesting activity going on in that traditional space. And then the flip side is our specialized financing structures. These are things that we talk about more, things like PACE or on-bill products that are tailored specifically to energy efficiency. And then we also have sort of a gray category of loans that are offered by an energy efficiency program, but are sort of more a standard loan product, unsecured loans. And that's the focus of our presentation today. So this kind of speaks to your answers to the poll questions. So the central premise of why we think secondary markets are exciting for energy efficiency finance and why we think they're getting attention is laid out here. So one, that secondary markets can offer a greater supply of capital, and two, that in the long run they may offer a lower cost of capital, which would then translate through to lower interest rates on energy efficiency loans, which would in theory lead to higher demand. So you can see that sort of all of your answers to the poll questions are kind of linked together. On greater capital supply, I'll just say that the thinking there is that traditionally energy efficiency loans are offered out of a limited pool of dollars, whether it's ratepayer funds or federal funds, whatever it is, it's typically a finite amount of dollars. And if demand for energy efficiency loans exceeds the amount of capital you have available, you get stuck in a pickle where you can't be originating new loans. So the idea there is that secondary markets could be a solution if your demand outstrips your supply of capital. And on lower capital costs, you see here it may be lower in the long run. I'll just point out one, there's many reasons why secondary market capital can be low cost. I'll point out one that we speak about later, which is liquidity. And what we mean by that is that that really applies to bond structures. But if you have an instrument that you can trade, the investor is likely to require a lower yield or a lower kind of interest rate on that money because they feel confident that, if I purchased a bond and I didn't want it anymore, I wanted to get my money out, I could just sell it easily to Chris or to Johanna, and so I would feel less, it would feel less risky to me to own that asset. And we'll talk more about these throughout the presentation. So one dynamic that we encountered in our research that we want to call out up front is this trade-off between short-term and long-term objectives. And what we found is that while the secondary market for energy efficiency is definitely in its early stages, we've only seen a handful of transactions so far, we also do see some program administrators who seem happy to be early adopters, for lack of a better word. And that's what this graph is attempting to show you. So the y-axis here would be level of, just call it level of demand, or dollar amount of loans that of energy efficiency loans that have been taken out. And so we do see that there are some people in this bottom left corner whose program maybe is still maturing, maybe they're still building demand, but they want to take a focus today on ensuring that the products they're offering can be attractive to secondary market investors in the future once they need to access that secondary market capital. And then we see other folks on the right-hand side of the graph who prefer to wait to build up demand and loan volume before they pursue a secondary market approach. So that's just a dynamic that we saw out there to be aware of. And I think we've got another poll, and we want to pause for questions at this point before we go on. So let's do maybe pause for questions first and then move on to the poll. So Michael, if there's any questions that have come in, we're happy to take a couple here. And if not, then that's fine. We can keep going.
Yeah, we're actually still awaiting some questions from the audience. So let's go to the poll, and then
right.
If a few questions come in after that, we can go to those. Otherwise, we'll keep going and just save a little bit more time at the end.
Sounds good. you all should see another poll coming up shortly. And it's related to, imagine if you were running an energy efficiency financing program, which of these approaches do you think you would take? Would you be focused on secondary markets now or later or something else? We're pretty curious to understand how you all would feel about that choice. And whenever you're ready, whenever it seems like responses are slowing, Michael, go ahead and close it. And then we'll have Chris summarize the results for us.
Great. So let's see. So we had high answers on the first couple and a little lower on the second couple. So 43% said right away I'd be interested in a one-stop shop option. 44% said once I reached a certain level of volume. And then 12% said I'd consider a capital supply alternative in the short term, and only 1% said I wouldn't consider secondary markets at all.
Okay, not surprising, since you probably wouldn't join the webinar if you weren't interested in secondary markets. Okay, so a pretty even split between the kind of consider them right away versus wait until you've generated volume, which not surprising. So thank you all for sharing that with us. And I think we're back to my...
We do have a question.
Oh, sure.
That's just come in from Mark, and he asks, can you talk about the effect on underwriting standards when leveraging secondary markets?
Oh, absolutely. I would rather defer it. Chris actually has a slide on underwriting standards and other criteria. So if that's all right, could we take that a little bit later? I'll take that as a yes. Okay. But Chris does have a whole section on. That's a good question. So for now, I'm going to move into discussing the secondary market structures that we observed in doing this research. Essentially, how were energy efficiency loans sold and packaged, and what did that look like? Before going into that, I want to emphasize that we focused on transactions that are supported by the repayments from the underlying energy efficiency loans. And so what I mean by that is that we didn't look at examples where, for say, a municipality issued a general obligation bond that was just based on their own creditworthiness and then used those proceeds to issue energy efficiency loans. Rather, we looked at the reverse scenario, where the loans are existing and then the bond or the portfolio sale is done based on those loan assets. And the reason we did that is because that approach, where you're originating loans and then accessing secondary market capital, we feel that that's more scalable, because as long as there's demand for loans, you can be creating secondary market products and selling them on to investors. So we purposefully are focusing on just those types of transactions. And you'll see here in this figure that we saw basically two main approaches. One is a loan portfolio sale, and the other is bond sale, and then there's subcategories within bond sales, revenue bonds, and then asset-backed securitizations. And we'll go through each. Okay. On this slide, I'm sure it's pretty difficult to read. That's fine. We don't want to discuss this in detail. We sort of want to put a plug here for our second webinar, where we will be focusing more on some of these early transactions of energy efficiency loans that we saw. There's 10 overall, 8 that have occurred and 2 that are forthcoming. I'll just make a couple points here on this slide and just encourage you to join the webinar on the 31st if you're interested in hearing directly from some of these programs. So points I would make here is that all of these transactions are pretty recent. The oldest or the earliest occurred in 2011. They're also all fairly small volumes, ranging from 15 million to 130 million at the largest. The underlying loans that the secondary transactions are based on are from most sectors. There's residential loans, commercial loans, public loans, so that's encouraging. And then also each transaction featured some kind of credit enhancement. Chris is going to speak to that point in a little more detail, but I'll just say that essentially that means that investors seem to require a little bit of risk mitigation for these transactions to make them happen, likely because they're very new and are just emerging. So into the transaction structures. The first one we saw was called a loan portfolio sale, also called a direct loan sale. And it's a pretty straightforward route to secondary market capital. You can see it kind of diagrammed here on the right. You start with program participants who are taking energy efficiency loans. And then this blue box, the originator, who's typically the program administrator, then just directly sells, some or all of those loans to another investor who is the secondary market investor. And what doesn't happen is that the loans aren't transformed in any way. They're just directly sold to this other investor, which makes this transaction more simple, but it also introduces a challenge in that it can be difficult to find an investor who wants to hold the loans until maturity in their original form. So these loans aren't tradable. They're not bonds or packaged into securities. So that's the downside. But nonetheless, we do see this as a pretty straightforward route to accessing secondary market capital. We saw at least 2 examples of a portfolio sale that successfully brought new capital into the original program. And then the more common structure, or the structure that I think the vision of secondary markets relies on, are these bond sales, which is this next slide. And again, there's 2 types of bond sales that we saw: revenue bonds and then asset-backed securitization. In the diagram, you'll see that the main difference between the portfolio sale and the bond sales is that you have this step where the issuer creates a bond that's backed by the loan revenues. So the loans are packaged and transformed into tradable securities and then sold on to secondary market investors. So instead of buying a loan, they're buying a bond security. We have a slide on revenue bonds versus asset-backed securitization, but I'll just point out here that the difference is that only certain types of entities can issue revenue bonds, typically municipalities or other public agencies, whereas asset-backed securitizations can be issued by any type of organization. They require a little more complexity in that you tend to create new legal structures to hold the loans and issue the loans and things like that, but they are accessible to all kinds of issuers. And then this light green box on the bottom, I'll just say quickly that we did see that the purchasers of these energy efficiency-backed bonds were from 2 major parts of the bond market: the private placement market and then the public market. And when you think of the bond market, you're probably thinking of the public market, but there also exists a private placement market, which is a little smaller, probably at least an order of magnitude, if not more, smaller than the public bond market. And the purchasers in that market, I couldn't go and purchase a bond in the private placement market. It's only for a certain type of investor. So just note that. We may come back to that, or we can take some questions on that. But we did see that about half of the transactions utilize the private placement market instead of the public market. So last word on transaction structures before I hand it over to Chris, who's going to change gears and take us through the second half of the report, just comparing quickly revenue bonds versus asset-backed securitizations. So these were the 2 primary bond approaches that we saw. Revenue bonds, as I mentioned, are only available to certain types of entities, although it does seem fairly easy to create a partnership with a public sector entity if you need to. Revenue bonds are relatively simple, and they may have lower transaction costs than asset-backed securitizations. There are fewer parties involved because you don't need to create these special legal entities or special purpose vehicles to hold the loans. And rating agency fees may also be lower because the rating methodologies for a revenue bond, a municipal revenue bond, are a little more straightforward than for an asset-backed securitization. However, asset-backed securitizations, you could argue, provide a path to a larger total pool of capital. Asset-backed securitizations tend to be created in tranches, which essentially is just kind of a different flavor of bond that may be attractive to a certain kind of investor, so that by creating those tranches, you might attract a larger total pool of investors to your bond sale. And the asset-backed securities market is a little bit larger than the municipal revenue bond market. So both of these markets are very large and certainly are sufficient to meet demand for energy efficiency loans that we're seeing today, but just want to point that out, that there are these kind of two bond markets that are out there and two approaches that we saw. So we can pause for questions now, and then we will pass this over to Chris. Chris, do you want me to make you the presenter, or do you want me to advance the slides for you?
Oh, that's fine. You can make me the presenter. If it doesn't work for some reason, I'll switch it back.
So I will work on that while we take any questions that have come in.
Great, thanks, Emily. We do have a few questions coming in now. So the first one from Joe is, are there any instances you know of where investor-owned utilities have directly engaged in secondary market transactions?
Not that I am aware of. You know, oftentimes the utility is involved in some fashion in these energy efficiency programs, but typically the issuer has been a public entity or a municipality, or it's been a private entity, like a private energy efficiency loan financier. Chris,
Emily, I'll just add a little bit to that too. Two quick points. One, if you're really specifically focused on IOUs, in other words, investor-owned utilities, as opposed to sort of the broader category of program administrators, then we don't have examples in this paper of that. I'm not sure that there have been any, but there are some examples of other kind of analogous program administrators, like NYSERDA and the Delaware SEU, that are, program administrators who've gone through these types of transactions. The other thing, which I won't get into in a lot of detail, but a little bit has been said enough publicly at this point that I think I can just go ahead and say that there is some exploration of possible secondary market activity among utilities in Connecticut. I think that's about as much as I'll say on that at this point, since some of that's in process. But that's being investigated, and what I just said is public at this point.
Okay, great.
Great.
So we, I guess one more question maybe now before we start with you, Chris, and that comes from Tom, who asks, are there sample energy efficiency contracts available for us to review between program participants and the program administrator to show what cash flow is guaranteed?
To show what cash flow is guaranteed. Between the program... Go ahead, Emily.
I think the question is probably around maybe, how in mortgage contracts you can go and look at the standard mortgage agreement. Is there anything like that for energy efficiency? There may be, not that I've seen that are easily publicly available, but it's possible that these program administrators could share, especially if you're considering a program. I imagine they would be open to sharing some of their loan agreements with you, or they may be publicly available if you work, if you do your due diligence and wind your way down. Do you know of any, Chris, that are like a standard version of an energy efficiency loan agreement?
Maybe I'm just getting a little hung up on sort of the relationship, if it's between the program administrator and the customer. Yeah, I'm sure there are some examples probably out there. I'm trying to, of those types of agreements that we could, dig up and share. In terms of sort of its impact on secondary markets, I think that's what I'm trying to think through in terms of the answer. But we do talk a little bit in a few slides from now about, what, in fact, actually right here, sort of what investors are expecting. And one of the things that they will look at is, what's the risk on the underlying cash flows. And so that might be, seeing the actual agreements might be something that, would be of interest to understand, the likelihood that the cash flows are repaid. It may come into play in that sense. So I think I'll leave it there for now. Okay, should we go ahead? Can you all see my my slides at this point?
Yep, we can see them.
Great. Okay, so as I just mentioned, we'll talk a little bit about investor perspectives. So one of the things, if you have a need for accessing capital through the secondary markets, that's fundamental, is to work with the investor community to address any concerns about the underlying risks of the loans that are either being sold directly or are backing the bond transaction. And there are essentially two ways that we identify in the report that those concerns can be addressed. One is to provide sufficient information about the underlying loans or other financing arrangements that the investor feels comfortable about, that they really understand what the risk is. And that doesn't necessarily mean that it's always a low risk. It might just mean that they, feel familiar enough with the transactions to address that risk. If the risk is a little higher, there might be a higher premium. But at least giving them enough history so that they feel comfortable. And I think in a lot of cases, the perception among program administrators is that the risk may be lower than is sometimes perceived in the investor community, in part due to lack of familiarity. So one of the goals of some program administrators in thinking about secondary markets is how can we bridge that gap or narrow that gap between perceived and actual risk. And one of the ways to do that is to build up a consistent performance history that you can bring to the investor community to provide them as much information as possible about your transactions. That said, there are certainly plenty of programs out there that are relatively new, that may not have, as much of a performance history, or the data that they've collected may not be in the form that investors are looking for, or there may be certain things about the, transaction structures that make investors, at least for now, feel less comfortable. And so there are certainly other ways to work with the investor community as well to structure the transactions to mitigate risk. And of course, one of the things that Emily mentioned earlier that can be a major piece of that is offering various types of credit enhancements. And there's a slide later that talks about some of those types of enhancements. In fact, here it is. So we talked a little bit about, first of all, providing information and building up a performance history. One of the things I'll say about this, in addition, is that even for programs that may not have a whole lot of loan volume initially, or maybe that may not be in a place where they currently need capital from the secondary markets, some programs still, even early on, may decide to structure their loans and their transactions in a way that they think investors will be comfortable with in the future when that need becomes more salient to them. In fact, one of the rationales for joining some of the more kind of, what do you call it, cookie cutter is the wrong word, but kind of standardized structures that are out there that we explore in the paper is precisely that the transaction history that you'll build by participating in one of those structures is specifically intended and designed to be built up in a way that makes investors feel comfortable. That said, again, if need be, you can certainly also structure in various types of credit enhancement. I won't go through this whole list, but it is explored and defined in the report. But just note that there are many different types of credit enhancement that can make investors feel more comfortable, everything from selling loans at a discount to providing guarantees or loan loss reserves. In some cases, the program administrator might, for example, provide subordinate capital, which would potentially take a or take a loss, and if returns aren't quite what they expect, and that risk would go first to the program before it goes to the investors. Or the investors might not provide the full amount of the sort of net present value of the expected cash flows. They would actually provide a little less, and that's basically essentially selling the loans at a discount. It should just be noted that all of these things are not without cost. So accessing secondary markets, there are a number of reasons why there can be costs associated with it. Credit enhancements is definitely a big one of those. I think at this point in particular, given that we're sort of at early stages in the market, the amount of credit enhancement that may be needed can be somewhat significant. That's not always true. It depends a little bit on what your transaction structure is. So for example, we do explore some PACE transactions where the security on the loans is fairly high to begin with, so the amount of additional credit enhancement may be less. But in a lot of cases, we did see that the amount of credit enhancement needed was either significant to begin with or may have actually gone up when a sale was made. So on that note, there are also some program design considerations to take into account when you are thinking about, whether to build in secondary markets as a consideration into an energy efficiency financing program. This kind of goes back to Emily's slide on supply-focused and demand-focused perspectives. One of the things to think a little bit about is, how do I best build demand for energy efficiency and use financing as a tool to do that? Am I better off, setting rates and terms in ways that are most flexible, most attractive, and will generate the highest amount of participation? Or do I need to think a little bit more long-term and say, well, by the time I get to a point where I may need to access additional capital from the investor community, I'll have wanted to set things up from the beginning in ways that make that community feel comfortable so that I can then access more capital in the future. And those are just things that need to be considered. There are sometimes ways of bridging that gap and doing both, but these are program design considerations that are worth taking into account. So certainly interest rates, there are a lot of energy efficiency programs that offer fairly low or even 0% interest. There are ones that offer longer terms. We had an example of a lender who offered 20-year terms initially and then cut that back in part because of thinking about how to make the loans most saleable. And underwriting criteria. This goes back to the question that was posed initially, which was, how do secondary markets affect underwriting criteria? So I don't think that there's a one single answer to that question, but I think as a general principle, investors may have a different perspective than energy efficiency program administrators in terms of how to set underwriting criteria. So, for example, if on the residential side, where you set your minimum FICO score or where you set your debt-to-income ratio, how much debt you think, borrowers should be able to take on, for example. That might be different from a policy perspective and in terms of providing access to capital to sort of the broadest, still prudent, but kind of a broader range of potential customers than investors might be comfortable with in some cases. So that's another sort of consideration to take in mind. There are some programs, NYSERDA was one that we looked at that actually established 2 tiers of underwriting specifically for to address this concern. One of the, tier 1 was essentially the tier that was meant to be saleable, and tier 2 was the one that was meant to be more flexible. So there are things like that that you can potentially explore in program design. But there are also, obviously additional kind of administrative costs that come along with that. And it's also just hard to know from the beginning, well, where do I draw the line? What will investors really be comfortable with, and how do I decide? And, maybe I'll have access to some credit enhancement later that would actually allow me to sell more loans than I thought. So those things are kind of hard to guess from the beginning, but there are possibly ways to bridge the gap. Another program design consideration is, what type of security will be attached to your loan. So I mentioned PACE, for example. There, may be some advantages given the, this isn't a PACE webinar, but I'm sure you guys are, a lot of you at least, pretty familiar with the additional security that PACE can provide. And, if investors are in a pretty secure position, then maybe they'll be somewhat more comfortable with the transactions and require less credit enhancement to get them over the line. There's also some discussion of on-bill loans and whether shutoff could, provide that type of security, but I think that's an outstanding question at this point. So bottom line, program administrators should be aware of all of these trade-offs when they think about, setting up an energy efficiency financing program or, what changes they may want to make to it. There's no sort of right answer here. It's just about, how do I build demand at the same time, making my program attractive enough that if I need secondary market capital in the future, I'll be able to get it. One other factor to keep in mind as you're thinking about all of those considerations is that there are some other ways, out there, and Emily mentioned a few of these earlier, to get capital for your program. And really one of the things you want to think about is, well, how much capital and at what point will I need to access additional capital beyond what I have right now? So Emily mentioned, for example, that in many cases energy efficiency financing programs start by using either public or ratepayer capital just to make direct loans. There are obviously a bunch of programs that are partnering with private capital providers as well, whether that be local lenders or other sources. But just at the most basic level, if you have access to public or ratepayer funds and you're just trying to build demand, those are certainly low-cost funds that can, allow you to be pretty flexible in how you set up your program. But of course, over time, as demand does build, you may be somewhat limited in the amount that you can provide. In fact, a couple of the programs that we looked at specifically started out with that type of capital, and the reason they needed to access the secondary market was precisely because they basically ran out of the amount of money that they could access with that type of source. Another way to do it is just to sell a general obligation bond. I believe Emily mentioned that one as well. States and municipalities and some other sort of quasi-public entities may have the ability to sell a bond that they can then use the proceeds to fund, say a revolving loan fund or that type of thing. But again, there often are limits on how much of that type of activity, or at least considerations about how much of that type of activity those types of entities can take on, and so at some point they may need to look beyond that as a source. There are some interesting examples too of selling ratepayer-backed bonds. So, for example, this is a little bit like a general obligation bond, but instead of the credit of the municipal entity backing the bond, it might be just sort of ratepayers more generally. So Hawaii, with their GEMS model, which I can't even remember right now what that stands for, but is an example of this. And again, relatively low-cost capital, but eventually maybe somewhat limited. And then lender networks. So Massachusetts Heat Loan is an example of this. Massachusetts has got something like 50 to 60 local lenders that fund their heat loan program. And they're able to get up to in the range now of around $100 million a year. So there really is a lot of capital that you can potentially access with that type of network, and they're still relatively low cost. They may not be as low cost as say ratepayer funds, but they're lending at around 5%, which is then brought down to zero over a period of maximum term of 7 years. So you can really get a lot of capital depending on where you are with your program using those local lender networks. So again, in the short run, these alternatives may come with lower costs, but in the long run, basically the bottom line here is capital may be constrained. I think we were going to originally take a question after 18, and I forgot about that. So Michael, if there are other questions, I'm happy to take them after this slide instead.
Yeah, we actually have a question directly on the slide that you just presented, and then we have a few sort of going back. So maybe we pose that first question and then maybe one other, and then we keep going. Sure. So Lisa asks, why do you say that general obligation bonds are not tied to energy efficiency loan revenues? Take a state energy loan program funded with general obligation loans. Borrowers repay these funds over time.
Right. I think I think what, at least in some examples, what will happen is you sell the bond and the funds really are repaid through some other type of tax or other levy that's really the primary source for repaying that general obligation bond, and the loan itself is the bond itself is really backed by the credit of the issuing entity in that case. So there are really kind of two distinctions here. Yes, you can certainly put those funds into a revolving loan fund, but often the repayments then will just be recycled within that revolving loan fund and lent out again. So I think the two sort of key distinctions are, where is the real source of repayment for that bond coming from, and also, kind of what is the underlying, I guess those are sort of related points, but what's the underlying backing for that bond? So as Emily mentioned earlier, one of the real thoughts about scaling up energy efficiency financing programs using secondary market capital is that those transactions tend to be backed really directly with the, not with the credit of the issuing entity, which can limit the amount that they can do, but really just directly with the underlying loans, and that the more of that type of activity you can do, the sort of larger your program can get. Emily, anything?
Okay, great.
Great.
Emily, anything to add to that?
No, I think that's well said. Maybe the important word is only backed by the revenues from energy efficiency loans, which is the structures that we're focusing on here, these revenue bonds and asset-backed securitizations, where they don't have the fallback of the general faith and credit of a municipality or a state backing them. And the investors look at those energy efficiency loans then as the only kind of asset or collateral that they will be repaid from, versus, well, yes, maybe maybe these loans will perform, maybe they won't, but even if they don't, I'll still have the state, I know the state will make good on its GEO bonds.
Great, great. And maybe I'll go on, actually, if you can hold the second question, just so we make sure we get through the rest of the slides and leave time if that works.
Yeah, no problem.
Okay, great. There are only actually a couple more slides here, but we did want to point out, and this goes to the report as well, that we had created a sort of decision tool. Emily worked hard on this, and I did a great job, and put together a decision tool that helps walk you through sort of, if you're in the stage of program design, how should you think about integrating secondary markets, or how and whether, I guess, to integrate secondary markets into your program design. So I won't walk through the whole thing, but at a general level, the first question is basically, what's your level of demand now, and what is it likely to be in the future for energy efficiency financing? Essentially, how much capital do you think you'll really need? And then it goes down into questions around what capital supply options are available to you, secondary markets and some of the other alternatives that we talked about. And then assuming that those options are all available, it then moves on to, okay, well, what are the pros and cons and trade-offs of those various options, and what are some of the considerations to think about? The amount of capital supply, the cost in the long run, versus some of the program design trade-offs, for example, and some of the shorter-term and costs like credit enhancement that we've reviewed. So hopefully that tool will be helpful to folks in thinking about how to incorporate all of this into their program designs. So then just another couple more, two more summary slides. This is all stuff that I think we've mostly reviewed, but in the long run, secondary markets offer essentially a virtually limitless, low-cost capital source. But right now, we're still really at the early stages of all this stuff. So, we reviewed 8 transactions. It doesn't capture everything. There are other ones out there in the market, but it actually captures a pretty good cross-section and of what's been done so far. At around $400 million. Often you'll hear folks say that really anything from 25 to 50 to 100 million is kind of almost like a minimum level for what you might expect in the secondary market transaction. And you can see in terms of where we are right now that we're still at relatively lower levels, but certainly the market is developing. Some program administrators may choose to focus on secondary market strategies right now and build up a transaction history so that they can get the capital when they need it. Whereas others may choose to make program design choices that will help them build demand and meet other policy objectives, such as open access to capital. And then we reviewed two main types of secondary markets: loan portfolio sales, secondary market transactions, including loan portfolio sales and bond sales. Within that, we looked at municipal revenue bonds and asset-backed securitizations. We made the point that all secondary market transactions, do have to build in risk mitigation strategies, whether that's providing information or right now providing credit enhancement and other things that may carry costs with them. So just something to think about. And finally, balancing sort of long-term and short-term objectives. Program administrators should think about what are the considerations that they'll have to take into account if they want to build secondary markets into their program design: interest rates, security mechanisms, and underwriting criteria, versus the ability to meet long-term capital needs and access low-cost capital over time. Think about, as you're thinking about all of this, what's your level of demand likely to be, and what are your options and constraints when you think about which of those avenues to pursue. Great. So I think that's it. And with that, we can take any more questions. Got about 5 minutes left.
Great, thanks so much, guys. Okay, so I've got one, well, I've had a couple of people ask questions sort of related to the same topic, which is about the unique challenges that energy efficiency projects pose when it comes to secondary markets. You know, the unique quality assurance issues, M&V protocols, and how those are actually carried out in these transactions. I was wondering if either of you could speak a little bit about that.
Sure. So M&V protocols, and I'm sorry, what was the first piece of that?
It was just QA, quality assurance, and
quality
assurance.
Assurance.
Specifically about how M&V protocols would fit into that process.
Right, right. Well, I'll try to answer that from sort of a broader perspective, which is to say that, you know, I think one of the key themes that we do look at in the paper is the idea of standardization and energy efficiency as an asset class. And I think QA and M&V protocols sort of play into that in the sense that, you know, one of the long-term potential objectives of building secondary markets into energy efficiency programs is the idea that, you know, over time it may be possible to demonstrate a link between project performance and loan performance. That is to say, you know, the better your energy efficiency project performs in terms of throwing off those underlying cash flows, the more likely it is that you as a customer will be to repay your loan, or the more likely it is that the investor will see the return that they expect. So I think things like QA and M&V protocols can make investors eventually, over time, as they get more familiar with the market, become more comfortable that that link exists, is real, and may over time adjust their costs. I keep saying over time and kind of caveating that because I think that's right now a work in progress, and there are a lot of questions around that kind of remain to be answered. But that's the general principle. Yep.
Yeah,
Emily,
Emily, I would agree. I would just say that currently probably the majority of investors haven't seen enough data or aren't familiar enough with energy efficiency loans to follow that storyline of reduced risk due to the fact that energy efficiency loans generate savings. So I think that it is definitely an over time issue.
Yep.
Okay, great. Well, Chris, as you predicted, there is some interest around PACE programs amongst our listeners, and one of the questions was why we haven't seen much action on secondary markets regarding PACE programs.
Great. Good question, although I will say that actually a couple of the transactions that we look at are PACE transactions, so we didn't focus that much directly on PACE in this webinar. I will say Emily mentioned the webinar on the 31st, and I don't think we've quite finalized all of that, but I believe we will be highlighting a commercial PACE transaction in that webinar, so stay tuned. And, I think the fundamental answer underlying that is that, number one, there have been a few. Number two, there's a relatively limited number of underlying transactions. On the residential side, we don't need to get into all of it, but obviously there have been some regulatory issues around residential PACE that have limited the number of jurisdictions that have moved forward on it, but there are some, and the HERO transactions that we mentioned are structured around the residential PACE structure, and they're described in the report. And then on the commercial side, there are not as many regulatory issues, but there are also, sort of a limited number of programs that I think have done enough volume to reach the point where they have needed to access secondary markets. Connecticut is certainly one, and we do talk about that in the report, and I believe that we'll be talking about that on the 31st. And Toledo is also another one on the commercial side where they've structured, their program around PACE and have actually accessed the secondary market there. So it's moving along.
Yeah,
okay,
nothing
great.
to add. Go ahead.
Well, do you have anything to add, Emily?
Nope, let's try to fit another question. Go ahead.
Okay, great. Okay, now another couple of questions from Brian and Timothy around efforts at the federal level. So a lot of your presentation is focused on state or municipal level efforts. Do you see any efforts or potential for any efforts at the federal level?
Emily, do you want to take that one, or?
Gosh, other than to say, nothing imminent. as far as potential for at the federal level, I haven't thought through that in too much detail. I think you're right that, at this juncture, it is pretty kind of program administrator by program administrator, which is part of the challenge. Chris mentioned standardization as something that could help this market to evolve. I suppose, much as we saw in the mortgage market, federal government or federal regulators could take a hand in standardization, but I think that's a ways off. I think program administrators are still figuring out what works for them and their target markets, so I think I wouldn't see that in the too near future. What do you think, Chris?
Yeah, I think that's basically right. I mean, I think that a few of the agencies out there, like Fannie Mae, for example, was highly engaged in the residential energy loan side of things for a while, and there is some data there that's been useful to folks who are exploring potential for secondary market transactions. FHA is another agency, and HUD, where there might be some potential there. And then the other thing is, it's not federal, but, there are a couple transaction structures we explore, like Wheel and Kilowatt, that are open to multiple states. So, again, it's not federal per se, but it does cross multiple jurisdictions. Great.
Okay. Well, I think that's all the time we have. So with that, I'd like to thank Johanna, Emily, and Chris for what's been a really stimulating and I think really interesting presentation. I'd like to remind all our viewers that we have the second webinar in this series that will be on March 31st. That will be focused really on these case studies, so looking in detail at a number of examples of secondary market transactions across the residential, the C&I, and the institutional sectors. I'd like to remind everyone that the report that we've been referencing throughout this presentation is available. The link to it is in the GoToWebinar window, and that this talk today will be made online, will be made available online through the Yale Center for Business and the Environment website. So this is Michael Puckett from the Yale Center for Business and the Environment saying so long for New Haven, Connecticut.